If you're curious about donor-advised funds and whether they are a smart tax move for you, then keep watching this video as I'll dive into more about donor-advised funds and why they could make sense. Welcome back. This is episode 231. There are less than 20 days left in the year 2024. And if you are interested in gifting money to a charity this year, then you better get moving because you need to make any charitable contributions by the end of the year if you're looking to have a tax deduction for your 2024 tax year based on that contribution. And one way to donate to a charity is through what is known as a donor-advised fund. So in this episode, I'm going to cover what a donor-advised fund is, how it works, who should consider contributing to one, and then wrap up with covering donor-advised funds offered by some of the biggest investment companies out there, such as Fidelity, Vanguard, and Charles Schwab. So be sure to listen to the end. If you're new to my show, my goal each week is to deliver a great episode to help you prepare for your retirement, invest smarter, and minimize your taxes. To make sure you don't miss an episode, head over to retirewithryan.com and sign up for my newsletter. And as a free bonus while you're there, you can download a free chapter of my new book, Fiduciary, where I take you through how to hire the most excellent investment advisor that will help you and guide you on your journey to planning the ultimate retirement. So again, head over to retirewithryan.com and you can click on download a free chapter of my book or click on sign up for my newsletter. And Americans are very charitably inclined. Americans donate a tremendous amount to charities. It's estimated that last year, Americans donated $558 billion to charities. This is an increase of about 1.9%, according to USA report. And many people also donate time to charities. It's estimated that Americans donated last year 4.1 billion hours to charities, and that has a tremendous value as well. About 69% of donations to charities come from individuals. So if you are someone who's making a donation to a charity, a cash donation, a donation of investments, then you should definitely be aware of how this could also potentially help you reduce your taxes. So one way to do that, as I mentioned, is through a donor-advised fund. So what is a donor-advised fund? Well, a donor-advised fund is a charitable investment account that allows individuals to contribute money, stocks, or other assets to support those charities. And the way that they work is that these donor-advised funds are set up through a public charity or otherwise known as a 501c3 organization. So that's the sponsoring organization of the donor-advised fund. And then there's an account that's comprised of the contributions made by the individual donors. And once the donor makes the contribution to the organization has legal control over the donation. However, the donor's representative retains advisory privileges with respect to the distribution of funds and the investment of assets in the funds. So essentially, once you make your donor-advised contribution, you no longer control the asset, but you also have control over where the investments are being, the money is being invested, and also who and when is actually receiving that money from your donation. So one of the great things about when you make a contribution to a donor-advised fund is that you don't have to decide which charity you're giving the money to right away, and even when you're giving a charity to right away. I read an article by Warren Buffett who uses donor-advised funds, and his goal is for his money to double before he donates any of the contribution that he's made. So that he's not donating the original contribution, he's donating the growth, therefore allowing his original contribution to continue to grow for future generations. The question for anybody is, how long does it take their money to double? It's definitely a number of years, but it really depends on also how you're investing the money. So this can be different than other charitable contributions. You obviously can donate part of your retirement account to a charity. We've talked about that before. If you're over age 70 and a half, you can donate part of your required minimum distribution to a charity. But the difficulty with that is you have to do that you have to decide on which charity you're giving the money to at the time of the distribution. So the difference with this is that with the donor-advised contribution, you don't actually have to decide what charity you're giving the money to. So the money goes into the donor advised fund. You immediately get a tax deduction on the contribution that you put into the fund, and then you choose when and who to take the money out. So it's more simple. Sometimes it's compared to a private foundation. That's more complicated. You need to hire an attorney. You need an accountant. You need a board of directors. There's filing fees. There are some fees with an ongoing donor advised fund that I'll talk about in a little bit, but those fees are generally a lot less than if you're running a private foundation. So who are these donor advised funds right for? Well, they're definitely right for people who are consistently donating money to charities and are not currently able to deduct that donation to a charity. So why wouldn't you be able to deduct a donation to a charity? Well, currently you can only deduct donations to charities on your tax return above $300 for an individual or $600 for a married couple filing jointly if you're able to itemize deductions. So let me say that again. Let's say you give $1,000 to a charity in 2024, but you can't itemize your taxes. If you're a single filer, you can only deduct $300 of that charitable contribution on your taxes. The remaining $700 is not deductible. So you would therefore then need to make larger contributions to be able to itemize your taxes. I talked last week about some of the potential tax changes that are coming under the Trump administration, and one of those changes may be an increase in the amount of state and local taxes that people can deduct, therefore allowing them to itemize their taxes and take a deduction greater than the standard deduction. So for those people that are looking to itemize their taxes, another item that counts to itemizing is a charitable contribution, but it has to be a large charitable contribution. So let's say you're consistently donating maybe $10,000 a year to a charity or a number of charities, but you still weren't able to itemize your taxes. Well, let's say instead you donated $50,000 to charity in this year. That would then maybe potentially allow you to itemize that contribution, therefore allowing you a larger tax deduction on these contributions, whereas normally you were only limited to the $600 a year of deduction because you're a married couple filing jointly for your taxes. So that is definitely who it can help. People that are making large charitable contributions and have the ability to make an even larger charitable contribution, because you could make that all in one tax year, let's say in 2024, but you don't actually give it to the charity in this year. You could make the contribution in 2024, and then it sits there in the donor advised fund, and you choose how to invest the money. And at some point in the future, you then choose when you want to give the money to the charity or which charities to give the money to. So it could also be good for people that have highly appreciated assets. If you have highly appreciated real estate, highly appreciated stocks, and you're looking to diversify your portfolio, but also give a charitable contribution, you could donate that real estate or that highly appreciated asset to the donor advised fund, therefore giving you a large charitable deduction. And also then you have the ability to give that money out to the charities as you're choosing. Now there's a limit for any tax deduction currently made to a charity as far as how much of that you can deduct on your taxes. So the limit is set by the IRS is 60% in any one tax year for cash and 30% for securities or other appreciated assets. So what do I mean by that? Let's say you had a large asset that had a large capital gain that was worth $200,000 and you donated all of that to a donor advised fund. So you've now created a $200,000 potential deduction on your taxes. But let's say this tax year, your taxes are only, your income is only $100,000. Therefore, you could only deduct up to 60% of that donation this year, therefore reducing your taxes. And then any future deduction or any future charitable contribution that you can't deduct on your taxes, you could then use in future years. So you can carry it forward into future years to be able to reduce your taxes as you go forward. But the nice thing is that now you've made that large donation to the donor advised fund and can choose how and when you want to use that contribution. So definitely people in higher tax brackets, people that have had large income in any one year. If you sold a business, you sold real estate, you sold a stock, and you have a large capital gain, a donor advised fund can be a great way for you to donate some of that gain to a charity and also receive a deduction. And then you can also donate the asset itself as well, if that makes sense. So who offers donor advised funds? Well, there's many companies that offer donor advised funds. So to talk about some of the biggest ones out there, as I mentioned, Vanguard, Schwab, and Fidelity, they all offer donor advised funds through their charitable organizations. So the Fidelity Charitable Donor Advised Fund has a $5,000 minimum to set it up. Vanguard's is also $5,000. Vanguard's is $25,000 and Schwab's is $5,000. So they have varying minimums that you need to set up. And then they also have certain amounts that you have to contribute. They're generally about $50 for each additional contribution. And, they range as far as the investment options. Right now with Schwab, Vanguard, and Fidelity, they all have some very low cost investment options that you can choose from inside of the donor advised funds. Now, one of the negatives with the donor advised fund is that there are annual costs to keep a donor advised fund at one of these three companies I mentioned. And that cost is about 0.6% per year. So that will be deducted from the funds you have in the donor advised fund every year. So that is definitely a negative. You usually think of these companies as low-cost discount brokers, but this additional 0.60% is higher than just having a standard IRA or brokerage account at these companies. But it is for the additional charges they have for administering the funds. But the beauty about the donor advised fund is that you choose the investments that you want to pick inside of these funds. So you get to pick the portfolio that's right for you and manage it according to what you're looking for. With two of these companies as well, if you use a financial advisor like myself, and they work with Schwab or they work with Fidelity, if once you contribute a certain amount, it's generally $250,000, your advisor could then manage the donor advised fund for you if that's something that you're looking to do. So there's definitely a lot of benefits about donor advised funds as far as the investments themselves. Now, there are a lot of other organizations that offer donor advised funds, and one of the things that you'd want to be looking at is what are the investment options that they offer, what are any costs that you'd be paying if they have costs for these donor advised funds. Most of them do. So you want to just do your homework and make sure, just like making any good investment, that you're getting a good return on your money and you have good investment options. So additional benefits to you, we talked earlier about the tax benefit. Obviously, there's tax benefits to doing this. There's also the benefit of donating to the charity, but there's the benefit as well as bringing your family aboard as far as getting them involved in the charitable side of giving. Because, as I said, once you make this charitable contribution to the donor advised fund, the money hasn't been given out. So part of an annual ritual with your family you could set up is that once a year you get together and you each identify some charities that you want to donate money to, and it can get your children, your grandchildren really more involved in the charitable giving aspect. And it's a great way to create a legacy as well, because this donor advised fund could live on for a long time because you choose when and how you give the money out. Now, anytime you're making a donation to your charity, it's always a good idea to do some research on that charity. Make sure you're giving it to a charity that sees as much of your money that you give to them flow through to whoever the beneficiaries are of that charity. And one way to do that is to go through a website like Charity Navigator. And I'll put a link in the show notes to Charity Navigator. Charity Navigator gives you a score on the charity as far as how good they are at donating or managing the money that you donate. And it's a good thing to look that up. So definitely check that out, because unfortunately there are some charities where a low percentage of the money you donate actually gets through to the people that most need it because of high administrative costs. So additionally, I mentioned about Schwab, Fidelity, and Vanguard. There's a helpful article that I found on Morningstar that delves even deeper into the specifics about the donor advised funds offered by these companies. So I'll put a link in that in the episode notes as well. So again, this is episode 231. If you head over to retirewithryan.com ryan.com/podcast/231 for episode 231. You'll find a link to those items. So what are your action items with this? Well, as I mentioned, there's not a lot of days left in the year to do this. So if you're looking to do this, you need to make a quick decision about which donor advised fund you're going to go with, and then make sure you make that contribution by the year end. So if you want to take advantage of this for the 2024 tax year, you do. And certainly if you need more time and you can wait till next year, you could also wait till next year. But again, look at the amount of money that you're donating to charities and look at your tax return, figure out if you're itemizing your taxes. Chances are you're most likely not. And if you aren't, maybe a charitable contribution to a donor advised fund can be really helpful to save you some more money in taxes by allowing you to itemize and also allowing you to be able to continually give to charities, throughout your lifetime. So thanks for listening to this episode and watching. As always, if you have a listener question that you want to consider, you can head over to retirewithryan.com and click on Ask a Question. And if you're looking for a financial advisor, Morrissey Wealth Management is currently taking on financial new clients. So if you're looking for a new financial advisor, you can head over to retirewithryan.com and click on Free Assessment to read more about the free assessment that we offer to people that are looking to hire a financial advisor. And if you do take advantage of that, I look forward to talking with you. Have a great week, and I look forward to talking with you next Wednesday. Take care.